Okay, so when we closed on Friday, I marked out these two areas, these two zones. Watch how precisely it played out. So, what I am going to do is personally, I'm trying to focus more on the risk to reward in terms of time, not in terms of the pips or points, in terms of in terms of time. So what I'm going to do is I'm going to frame a bigger pictures narrative, which is going to be around for 4 hours time frame, and in that framework, we are going to navigate the market. First, watch this how this played out perfectly. Okay, so where we are now, and watch how this volume imbalance is getting respected again and again and again. It's not giving a close below this monthly volume imbalance. So we'll remove this. We'll delete this shit. And 15 minutes. 15 minutes. Okay. First, in order for me to take a bias or a narrative, I know whether am I a bull or a bear. Am I going to long this market or am I going to short this market in the long term? When I'm referring to long term, I'm talking about at least 15 days. At least. Okay. So, first thing would be first thing would be, plus I'm going to give a target for this narrative. First of all, this overall thing which is going on, this is what I am thinking of as a bear. First, I have taken a position of a bear, then we'll frame a narrative and the validity of the narrative. So if I am a bear, okay, so what is the longer time frame extreme? If I were a bull, I would look at this market from the downside. Okay, I am talking about shorting this. Okay, in the long term, in the intraday, it can do anything. So what would be the extreme points? I'm going to show these things on a regular trading hours and on the electronic trading hours. Regardless, whatever the market do in the intraday, this is a longer term perspective. Plus, I'm going to give a target. When the target will get reached, then I'll move to day trading again. But this is the, so watch. We place this here. The coordinates would be, I'm using the recurring logic again and again and again. 16486, 16486, 164, 16520. Point. So this becomes the higher time frame extreme. This price area becomes the higher time frame extreme, and the more the price gravitates towards the extreme, the assumed risk. So I'll tell you what I'm talking about, the assumed risk. The second would be There are two types of risk. First is the risk which we assume, and then there is the risk which we perceive. And the perceived risk would be for the news and the volatility of these newses. So the next be background borders red line. These two are the extreme which I am assuming the risk is. Okay. In the intraday, I can see that the intraday market is up, is currently up. I have taken the position of a bear, so I'll be thinking of getting an entries in these 2 points if it gets close to these points. No, I think there's something is not right. This coordinates 16403, 16403. It's not this. Coordinates 16403. We have 6 minutes till the market open, but this is a long-term thing, so it doesn't really matter. 16338, 6338.5. Yep. The price is at the extreme. It's not necessary for the price to come back up, but this is the risk I am already taking into account. So delete this. For example, if the price is currently, the price is here, I would be assuming the risk of about 184 points. This is, you can trade within this frame. This is a framework. This is a framework I'm talking about to the low hanging fruit. Be about 456 points, 466 points plus, if we just move a little, just to be very safe, just to be safe, and 185 points risk. This is a narrative in which I am working, and I am framing my trades even in the intradays or even in the swing trades. So if you are taking this narrative and the price is going up, that would be short-term long, long-term short. Okay. So these extremes on the what would these extremes look like on the regular trading hours? See this gap, this is the only gap that is left unfilled. That is still in the playbook, that the price can come up this point. Then I'll be looking to go short, or I can take I can divide my position into tenths, and I can take a short here, take a short here, take a short here, take a short here, then the whole stop, all of these stop losses would be above this point, and my target would be 389.6556. This would be my target. So this opening range gap, which is left unfilled, becomes the area of interest, and I'll be targeting the opening range gap and the previous month's open on the regular trading hours to that point. So overall, I am short biased. In the intraday, it can move up and down, but that would fundamentally not change anything. It had to price to move to this point. Back to the can get strong and strong, can take these out, these highs out. That would move to the extreme of this downtrend. And there would be our target, the monthly volume imbalance, which is also at the previous month's close. Targets, this is the target, 15894.6, a monthly volume imbalance. This is a target. This is a framework that I'm working within. In this framework, it does not mean that the price can just come slide exactly down right away. It can take some days. It can take about 15 days, 15 to 20 days. So this is the longer term perspective I'm working within. And what would be the thing that would negate the whole idea? If the price moves above this point and stays above and close, that would negate the whole idea of this short. So we would be shifting our perspective to the upside then. Okay. This is enough. The market is open. Give me more trade.